Okay, yeah.
Welcome, everyone, to today's CalCAP webinar. We have a goodly number of people that have already signed on, and we're thankful for that, so we're going to go ahead and get started. Today, we have the California Capital Access Loan Program in partnership with the California Air Resources Board presenting a lender roundtable. And I just wanted to note that today's webinar is intended to be an interactive one. Our colleagues from the Air Resources Board are here with us, and they're largely going to be driving the conversation. And after some initial information for you about recent legislation and their compliance initiatives, ARB will be posing a series of questions to you with the hopes of getting a better on-the-ground view of the borrowers you successfully serve, the borrowers you cannot serve, and what program options there may be to help small business owner-operators get into cleaner trucks and strengthen your loan portfolio. So in order to facilitate the interactive conversation, we have a few pieces of housekeeping information and pointers for your successful participation in the Lender Roundtable session today. As a default, at the outset right now, every attendee is on mute. If you've logged on through your computer or tablet and will be using the microphone on your computer or tablet device, please select the Raise Your Hand feature on the webinar platform application so that our webinar organizers can see your hand. And then we will call on those who have raised their hand in order and unmute you. If you don't have access to a computer microphone, please use your telephone's audio to interact with the webinar. The instructions to call in should be on your webinar platform, but to reiterate, we'd like you to call the following phone number, 1-415-655-0060, and then type in the access code as follows, 607-373-299. Then it will ask for a PIN number, and the PIN number is 116. For those of you that are calling in this way, please immediately place your phone on mute, and also when you are not speaking, so that there is no background noise interference. You may unmute when you'd like to speak during the questions and answer period. Beyond that, if you have any technical questions for the webinar organizers, please use the chat feature in the webinar platform application to communicate behind the scenes with us. So with that, I'd like to introduce who we have here at the roundtable and the key speakers. I'm Renee Webster Hawkins. I'm the Executive Director of CPCFA. And with me is Anne-Marie Rogers. She's the Division Chief of the Compliance Assistance and Outreach Branch at the Air Resources Board. We also have Warren Hawkins. He's the manager of the Specialized Fleet Enforcement Section at ARB. And also we have Reza Madhavi, the Senior Economist at ARB. So with that, I'll lightly go over the planned agenda for the day. First, we're going to be hearing some information from ARB about Senate Bill 1. We'll also hear about their enforcement pilot project. Then ARB will be opening up questions for a Q&A period around borrower and high-risk borrower profiles. And lastly, we'll be exploring some options for coordination between the pilot project and the CalCAP ARB lenders. So with that, I'd like to turn it over to Anne-Marie to share with us about Senate Bill 1.
Thank you, Renee. SB 1 was a new law and includes provisions to help ARB with enforcement of the truck and bus regulations. Starting in 2020, DMV will deny registration to owners who are not in compliance with the regulations. In order to register with DMV, if you have a heavy-duty diesel vehicle over 14,000 pounds, you must be in compliance either through an allowable flexibility option and reported in ARB's reporting system, or your vehicle is following the turnover schedule based on engine model year. So, for example, if you have a 2005 truck, you have to turn over to 2011 in 2022. Or the vehicle is already a 2011 or newer model year vehicle. This automatic enforcement tool is important because we believe there may be up to 75,000 vehicles currently out of compliance, and we believe many of these are small businesses. To prepare for the implementation of this law, we have several efforts underway. We are preparing an outreach campaign to let the industry know what to expect. We are working with DMV to ensure a seamless information sharing process, and we'll be working collaboratively using some of their established outreach outlets. We are assessing financial assistance opportunities to help businesses turn over their trucks, and we're streamlining our enforcement processes. So that's why we're here today. We want to share with you a pilot project aimed at bringing the dirtiest trucks into compliance now and discuss how they may impact CalCAP and how we can work together to identify those who are facing financial hardship. And secondly, we need your help to develop profiles of truckers, as Renee mentioned. We need to understand the different groups in order to determine how to focus our resources, or what kinds of requests we may make to the legislature, and for whom. We have a few data sources that we're using, but we thought your experience in this effort would be valuable. So with that, I'm going to turn it over to Warren Hawkins to describe the pilot project.
All right. Thank you, Anne Marie. As Anne Marie said, we estimate that there are potentially around 75,000 vehicles that are non-compliant with the truck and bus regulation currently. Those vehicles, not only are they not compliant, are going to be subject to the turnover requirements beginning in 2020. In an effort to try to bring those folks into compliance, level the playing field, and get them prepared for 2020, the Enforcement Division has developed a streamlined pilot project that will be rolling out here shortly. We're starting with fleets that have been cited on road by our field enforcement staff in the past and have yet to clear up those citations. And we're also looking at not just that vehicle that was cited, but we're correlating it to other non-compliant vehicles in their fleets and targeting the company as a whole. In addition to the cited parties, we're also going to pull out information for pre-1996 chassis out of DMV, which those vehicles have been out of compliance for quite some time, and the only option they have is to turn over. We're going to be looking at those as well as other non-compliant vehicles in their fleet and target the fleet as a whole. So the pilot project is around 1,500 vehicles. Our process in the past, or our current process, is we notify the parties that we believe they're non-compliant. We identify the vehicles in there. We work with them for a period of time. Sometimes it takes up to 6 months to come to a resolution, and then we work out a compliance pathway forward. But with the new process, we're going to put them on notice that we believe that they're out of compliance, and they have 30 days to come to us and show that they're in compliance with the 2020 requirements, or have a retrofit and they're currently compliant. If they can't do that, we send them a notice of violation and we move forward with the enforcement process. Now, we have not done this process, so the pilot's important to understand for us if this process is going to work going forward, so we can reach a greater number of those 75,000 vehicles between now and 2020 to bring them into compliance and be prepared for those requirements. We anticipate the use of, we currently use registration holds for vehicles that aren't compliant and are unable to come into compliance, and we anticipate a larger number of use of registration hold through the California DMV, which registration hold would block them from being able to drive on California highways. And two, we anticipate that a large number of these folks or individuals will be smaller fleets, probably less than 10, and have financial needs, meaning assistance to come into a newer truck or the inability to do anything, essentially, because they're so financially strapped. So that brings me to Reza.
Thank you, Warren. To follow up on what was said earlier, we developed a number of questions to better understand the financial condition of the trucking industry and other industry impacted by SB1. I would like to hear your responses after each question I raise, so we can open the discussion on each one. The first question we would like to ask is, what is the typical profile of a borrower who enrolls in your program? Type of business they are engaged, small, large, the age, income, and other criteria you evaluate. And also, we would like to know that in the absence of the CPCFA, the program, what type of loan would they be available to this candidate? You can respond to this question. Any?
I don't hear anybody responding. Can you hear me?
Yes, we hear you.
Okay. This is Russell Smith from Pacific Enterprise Bank, and I can give you a general kind of profile of our CalCAP borrowers to date, which goes back about 7 years, if you'd like. Is that what you're looking for?
Yes.
So I don't have any real age focus. They're all small business. Their income is just about universally short when we look at a historical adequacy of cash flow. We look at the impact of the vehicle they're purchasing as both reducing their maintenance costs and increasing their revenue because of the work they can get with a better truck, which pushes them into what is probably still a marginal surplus cash flow looked at globally in terms of all their needs. They don't have cash in the bank. And would they be able to get a loan elsewhere? Probably only a 20% plus effective either lease rate or private money loan rate without CalCAP. That's pretty much, I think, a thorough outline at least. Oh, and they probably have a low, a bad FICO score because they, along with their neediness and historical tight cash flow, they've had a lot of delinquent debt. Often they've had a previous bankruptcy, which we factor into our decision, but it doesn't automatically disqualify them.
So if I understand, you said that only 20% would be able to get loan in the absence of the program?
No, I didn't say that. I said that they would face a 20% or higher interest rate, which they probably would default on, but that would be their only choice, or a really high-priced lease, one or the other.
What percentage would be able to get loan in the absence of the program? So
a loan from me? A loan from me? None.
No. None. Okay.
Or from a bank. In a competitive bank program, I don't think any of them would qualify based on what I said.
Okay, good. Any other? No. What kind of financial metrics do you use to evaluate an applicant? Do you basically base on your qualification on only the asset of the business or the owner? Or what type of terms, what type of analysis you conduct, quality of the financial statement or analysis of financial ratio, any other credit rating?
Are you addressing that to me or to the group?
To the general, whoever would like to answer.
Yeah, there's a few other people. Matt Schrapp at Crossroads agrees. It says none. I'm going to unmute Shervin Rashke here.
Okay, there we are. This is Shervin with Maxim. Just to echo a little bit of what was being said about the credit criteria. We are not a bank, but we certainly look to the CalCAP program to assist us in mitigating risk and allowing for the credits of our borrowers to qualify for transactions that we would otherwise not be looking at. And we're really looking at the owner-operators as a large part of our portfolio. And these owner-operators have opportunities. They have routes to haul. They have, some perform. This is going to be typically their equipment that's going to get them to perform the duties that the routes that they are going to haul have. And we look at various criteria outside of just their financial performance in the past. We look at their ability to turn profit from having the asset. We look at some structure on the front end of the transaction with respect to down payment and other things to make the deal work, and absolutely factor in the CalCAP reserve as part of the lost benefits.
Is there,
We have Matt Strapp on the line here. He is unmuted.
Hi, guys. Thanks again for the call. This is going to be enlightening, I'm sure. To the ARB gentleman who was requesting, what we use for credit criteria, these folks that you're looking at, these 75 some odd thousand vehicles that are currently out of compliance, these aren't folks who maintain balance sheets for the most part. These are small, independent, single truck operators, and Russ was right on point in bringing up the fact that either they have low or no FICO scores, they're going to need 20% to put down just to get into the loan in the first place, and then their rates are going to depend on the equipment, how long the term that they're taking is, so probably over 20%, and then the length of the loan range anywhere from 36 to 48 months, 60 months if possible, but it depends on the equipment, how many miles the equipment that they're looking to get in, what type of work they're doing. I don't think you can just easily come up with a catch-all percentage of who would be deleted or an average consumer credit profile for this particular subset, because it's unique. And as for us as lenders, CPCFA obviously is our risk mitigant. So if we didn't have this program, we would not be lending to these people. And that's the unfortunate reality. And demographics aside, we don't discriminate in who we're lending to based on demographics. We discriminate based upon credit history. And again, a lot of these folks don't even have any credit history. If they're out of compliance now, it means that they haven't been able to get into compliance, which means they're probably paying cash for their vehicles wherever they can scrap it together. So I don't think it's as cut and dry. There's no financial ratios that we're looking at or financial statements. These guys typically don't even have businesses. If they do a DBA, then that's not necessarily rare, but it's not the norm. So this is the credit profile that we're looking at.
Okay. We have a Marco Lucioni from Opportunity Fund.
Hello? Can you hear me?
yes.
Hi, so this is Marco Lucioni from Opportunity Fund. We are not a bank, and most of our borrowers are independent owner-operators. To the question on the previous slide with regards to in the absence of the program, who would we be able to help? And as Pacific Enterprise Bank shared, the structure of the loans that we make available would vary significantly. And the combination of the three determining factors for mitigating risk, which one would be the down payment, the second would be term, and ultimately the rates would have to also be modified in order to deal with the higher expected losses. So in the absence of the program, it is hard to say what percent would our lending be cut, but certainly the cost to replace those trucks would be much higher for the owner-operators. In terms of the different financial factors that we look at, there's a combination, as I'm sure everybody takes a look at, beginning with the credit history of the borrower, that most of our borrowers are below the national average, so therefore we are dealing with a segment of the population that is, in terms of financial history, not as strong. We would certainly take a look at the conditions of the equipment that we're financing, and typically these are older units, so they can access a unit so that it's not going to cost them significantly. We would certainly take into account the use of that unit to be able to blend the remaining usable life of that asset with the terms that we are using. And finally, of course, very importantly, the experience of the borrower that we are lending to. And again, we deal mainly with independent owner operators, and that is one of the factors that we pay close attention to, is how long have they been in the industry. And I would say this program has certainly helped the replacement of the units in a tremendous way.
David Katz did have something, but he removed his hand. I will send him a message to see if he still wanted to comment, so he may chime in.
Are there anyone else listening in that would like to comment on either of these first two sets of questions?
This is Russ Smith again. Just one last thought came to mind, and that is that a lot of these trucks, I guess, are retrofitted, and maintenance and breakdowns are the biggest cause of loss, and lack of efficiency of the truck in its operation is just another thing that brings down that operator and what he's doing. Trucks just don't run well with the add-on filters, I guess, and even some of the earlier engine models, they just don't perform as efficiently, and there's more breakdown. And again, from a lender's perspective, aside from all the borrower profile that we talked about, we also consider the engine and the probability of breakdown the biggest cause of loss, the probability of that happening. So that warranties become important, and they usually don't have a warranty available at a reasonable price. And if there's a breakdown, it's the end of the story. We're done. You know, we have to go find the truck, and it's usually just worth salvage value. So I don't know how that impacts your study, but I think it's relevant. Thank you.
I think that is relevant, and I'm wondering if you, Russ, or any of the other lenders have actually quantified sort of the loans for which you do suffer a loss, what percentage are related to breakdowns or inability to afford the mechanical repairs?
I have that study going on right now. I can't give it to you at the moment, but I could probably give it to you within a few days.
Great. Anyone else have a sense, even sort of a rough ballpark?
Richard Lapston would like to speak on Murphy Bank.
Great.
He should be there.
Yes, good morning. I would say that a high percentage of our delinquency problems are due to mechanical breakdowns. And just like the last speaker said, retrofit filters, that's pretty common in the industry, that they just don't work. But I think the biggest thing about this group that you're talking about is you're talking about a very high maintenance customer from the standpoint of them providing insurance. This is a class of business that they're going to have insurance one minute, and they're going to be canceling the next. And insurance is going to be running anywhere between $4,000 and $6,000 to add insurance, and then if you get some payments out of the guy, and then you get another year down the road, you're adding insurance again. So insurance is a very important part of this. But you're talking about people that you have to chase on insurance, chase on payments, and then when they go delinquent, trying to get a repossession agency to pick up a truck is another obstacle to come over. There's not that many people out there that want to go repossess a big rig. Typically this class of customer does not maintain their truck very well. And you got bald tires, you got engines that don't get maintenance, and there's just a tremendous amount of follow-up.
Thank you for that. Regarding the insurance and license costs, here at CalCAP, we, from our vantage point, we know that some of you have utilized our CalCAP for Small Business program to cover separate financing instruments that cover the costs of insurance and repairs, for that matter. And I wonder if any of you would like to sort of speak to that, and dually leveraging the programs and sort of what the cumulative impacts are on the success or not of that borrower paying to term on any of the debt that they have related to this cost.
Well, I assume that sort of directed at me. It's Russ again. And we're not doing it anymore, but when we were doing it, yeah, it's a market. So if we offer a product and the insurance agent is trying to match up a policy to a truck driver, and we offer a little bit lower price and better payment terms, which means their cash flow stretches to cover what they need. But this is also a debt that we need some backup on, because insurance premium finance has its risks. It made all kinds of sense to enroll that loan, which is only a 10-month loan, but still enroll that loan in a program and give that borrower something that they can handle the payment on more easily. Now, I would also point out that it's the important insurance and the most expensive part of the insurance is not the collateral protection for the vehicle. It's their liability insurance, without which they're taken off the road immediately if it's canceled. So they're really not that likely to default, because they have to have it to stay in business. But when it comes time for renewal, what's important is getting them a policy that the monthly payment on which they can handle. They rarely have the cash. These smaller firms rarely have the cash to pay the full year premium in advance. So it just made economic sense in the market to do that.
We have Matt Schrapp, who would like to speak. He is self-there.
Hey guys, sorry, and thanks, Russ. One quick thing, sort of going back to the equipment. If ARB, if you're coming to us to talk about, who the average CalCAP borrower is, and then compare that to these 75,000 vehicles that are out there, it's a different bag from our perspective, because right now, and to build on the maintenance issues that some of the other folks were speaking towards, right now these guys aren't operating vehicles that have retrofits on them, so they don't have the same type of problems. They can work on the trucks themselves. They can go to a shade tree mechanic. They don't necessarily need to worry about doing warranty work or doing serviceable maintenance intervals, because they're out of warranty, and frankly, these older engines or diesel engines are workhorses. So we're going to be looking at borrowers that have a massive amount of unfamiliarity with the technology and only know what they've heard, which is being perpetuated on this call, that the equipment is bad and it doesn't work, which is not true. It was mentioned that it's usually related to mal-maintenance or lack of maintenance for the equipment, the retrofitted OEM type equipment to fail. But either way, something that the state might want to look at, and CalCAP or CPCFA, whomever, is that for these borrowers, is to require some type of maintenance escrow account that they contribute to monthly, that's administered perhaps by the state or somebody, that then they can draw from when they have these type of failures. Because for insurance, they're already on the insurance program. They need to have insurance to operate. They don't know about how many times that they need to go clean out their filter or service their valves or any other type of their differential, whatever. Anything related to the emissions controls is going to be foreign to them. So anything that can help them identify potential pitfalls of that type of equipment ahead of time would be very valuable. This is a different group of people. The people who have not been complying with this rule don't plan on complying. That's the gist that I've gotten from these folks. Catch me if you can. I'll keep continuing to cut my rates because my costs of doing business are different. And all of a sudden, if I get cited, they're probably going to leave the industry and go into construction or something else. For those who want to stay in, if the ARB keeps saying, oh, well, maybe go get a financial hardship letter, they're just kicking the can down the road. So, you know, I'm appreciative of the Air Resources Board, you know, out there seeking information. Maybe not this, perhaps might not be the best format for it, but regardless, there's all these larger issues at play here that really come into, at the end of the day, is these borrowers are not necessarily the same borrowers that we've been dealing with in CalCAP, because these folks have been proactive, they've been in compliance, they got grants, they're getting a newer truck, or they're just proactive enough that they know they need a loan and they're going to do whatever it takes to qualify. These other folks, I don't think they care really. So I guess the point of that was maintenance escrow accounts. Thank you.
Moving to the next slide, I believe you already responded to the first question, but would you like to elaborate on the circumstances that can help an applicant to qualify if it's basically on the borderline?
Money.
On the program, yes. Other condition that can help that qualify, you know.
Money.
How much money would
This is Matt again, and sorry, not to be flippant, but you know, honestly, that's the hurdle. Lenders can qualify a borrower even if he has no credit score. Okay, if he's got time in business and maybe he's got some clients that he knows, a financial institution will approve him. The catch is that the approval comes with a 35% down payment and then a rate that's probably over 20%, if not higher. And so right away, that's the hurdle. If they have ghost FICOs or no FICOs, or maybe they have several different social security numbers or whatever, those things can stop people from getting loans. But what helps us applicant qualify is capital and capital reduction. So if that comes from an incentive, if that comes from a payday loan, wherever it comes from, money is going to be what overcomes the less than desirable credit. That's how we mitigate our risk.
So where are the current borrowers that are qualifying obtaining their down payment? If you can generalize.
Well, again, then sorry, not to speak for everyone, and this is Matt, and I'll just say this real quick. It's, you know, these are borrowers who see the writing on the wall, so they're going to their families and borrowing money sometimes. On occasion, rarely, a motor carrier will lend them money or perhaps give them some type of bonus to help offset that. Maybe they'll just go right to the motor carrier and get a truck leased directly back to them. They'll beg, borrow, steal, whatever they can do because they know that they want to stay in business, they need to be in compliance. Unlike the 75,000 other vehicles out there who have a devil-may-care type attitude. So, you know, this is a industrious group of people who have gotten loans from us. They've taken whatever they can do to get money. So that's from our perspective. That's typically what where we have someone will bring some money to the table because they've been saving, or they'll go borrow from a family member, etc.
I guess the next slide is also kind of somewhat related to the first one. We kind of want to know.
Is there anyone else, though, before we move on to the next slide, is anyone else like to add any thoughts about other contingencies or circumstances that might help the acceptance of these potential borrowers? No? Okay, I just wanted to make sure that everyone
Yes, that's good. Yeah, actually, this next slide is kind of related to the first one, if you may want to comment on that, is see how flexible you are in relaxing your standard in providing loan to those near-miss applicants.
Let me ask a question first, and that is, when you say how flexible are we, are you suggesting what bar might we lower in order to make such a loan on a conventional basis without some sort of a loan enhancement program? If that's the case, my answer would be we're not flexible, because the loss ratios are something that it opens up a whole new territory of risk and reward, and frankly, there's a big gap between what we do now on conventional loans and the risks in this type of lending. And I'll tell you, over the many years, I've heard many stories about banks that got in trouble doing truck lending. Frankly, they thought that it was good for a while, got big conventional portfolios, and something happened. And I can think of a couple of banks that actually, got under C&Ds because of truck loan portfolios. So my inclination has been only to do it in a program.
Yeah, I think all of these credits, these owner-operators, could be considered near bankable. A bankable credit is an established fleet that has balance sheets and owns equipment, or has leasing history, leasing property, and other equipment. So I think that most of the lenders here have policies that allow for flexibility for near bankable. And to jump to the next question, there's state usury laws that we all have to follow. A lot of that, my understanding, is related to interest rate and what can be charged. CalCAP caps that at 20%. So maybe you can elaborate on exactly what you guys are trying to understand between the federal or state level. Are you talking SBA, or are you talking federal lending laws? We use the state here in California, but default to what CalCAP requires. Bueller?
I guess the next, any more comment on this question?
Catherine Pendley at CAR has her hand up, but I sent her the audio pin. She hasn't been able to, so she wants to relay a question.
What was her last name?
Catherine Pendley.
Catherine Pendulum?
Pendley.
Catherine, our operator, is saying that he sees your hand up, but that you haven't activated the pin. If you have a question or comment, you can either activate the audio pin or perhaps write a question in the chat feature so we can get your input or your question. Okay. Anyone else want to comment on the underwriting standards? before we move on, we'll
move on to the next one. I guess you commented already on this next slide, but again, we want to know that what can we do for the applicant who do not qualify? Is there anything can be done for those applicants? Any comments?
You guys, look, all of these borrowers are below our guidelines. That's why we use CalCAP.
Yes.
We would not be lending to these people if we didn't have CalCAP, period. I mean, I would entertain any other lender on this line to chime in, to disagree with me. But from my understanding, and this is consistent with the messaging that you guys have been getting since the beginning of this call, we wouldn't be doing this. So, I mean, I don't profile the categories of applicants who find way below your current guidelines. I mean, define way below. What does that mean? Is it a limbo contest? How low can we go? What is the bottom of the barrel that we can scrape here? I don't, again, we wouldn't be lending to these people if it wasn't for CalCAP. And state agencies, incentives. Unfortunately, non-compliant fleets aren't eligible for incentives. So their only real, I guess, option is to go through CalCAP. And then they have to find a lender that's enrolled in CalCAP, number one. And then number two, find equipment that's going to be sensible for their credit profile and their vocation. So, when to talk about how many applicants are a near miss compared to those that are way below current guidelines, again, what do you guys think way below current guidelines is? Because that's pretty much every single CalCAP borrower since you changed the fleet size to 10 or fewer.
Yeah. Hi, Matt. This is Anne-Marie. We understand that you're lending to people that you wouldn't normally lend to, and I think we're looking at if you have suggestions or opinions about how to make this broader to not just that category right underneath where you would lend to, but is there an opportunity to lend to some of the other higher risk? I guess that's what we're looking for.
And there is. It's called a higher reserve percentage contribution. The more the state takes away from us, the more willing we're going to be to entertain loans for those who are way below. I mean, that's just, again, it goes back to money.
And Matt, also you had mentioned the fleet size. Can you elaborate on that, please?
Well, it's when we're looking at fleets that have 40 or fewer trucks compared to fleets that have 10 or fewer trucks, and the majority of borrowers, and I know CalCAP, I'm sure you have the data on what the breakdown is of fleet size that's been enrolled since it's been down to 10 or fewer. I imagine the majority are single truck owner operators, but we just don't see the same credit quality because the amount of units you own typically, of course there's exceptions, is indicative of your total business presence, your size, your operations, your wherewithal to carry debt, to manage debt. When you get into the onesie twosies or sometimes 10 or fewer, granted there's some very lean fleets out there who operate very efficiently who would be eligible for CalCAP that have 10 or fewer, but primarily as the time has been coming since 2014 especially, the credit profiles have aren't the same because of the 10 or fewer, that requirement. We can't offset with the higher, more quality credits in CalCAP. We're pretty much lending to these people who we wouldn't normally lend to. And the way the recapture is set up now gives us a little bit more comfort in lending to some of those questionable credits, but still a higher reserve contribution would be a great help.
How about the down payment, increased down payment? Which one is more effective, down payment or the higher reserve?
Well, but where is the down payment going to come from? Is the state of California going to use taxpayer money to help people get into compliance?
Well, that's a possibility. We're looking at...
State law says you can't do that, so I'm not sure where that money's coming from. And frankly, the industry in California, the trucking industry, who's been paying for this stuff since 2008, practically the last 10 years, billions of dollars invested in clean equipment. Now the state of California is going to come along and give free money to people who have been out of compliance. That seems to be an unfair proposal. And I am sure the California Trucking Association, the Harbor Trucking Association, the Western States Trucking Alliance, everybody would be all over you guys in a heartbeat if you tried to give money to these people. CalCAP, we take the risk. If there's, again, I just don't see a viable option coming from the state for down payment assistance. And unless you guys are changing state law and planning on going to the legislature to ask for this, I think that's a big ask. A higher reserve is easier to be digested because the borrower is really just dealing with the lender, and if the reserve is high enough, we can offset the down payment requirements because we feel comfortable with the coverage from the state as well.
No, we're just raising question, just looking at all options, there is nothing at this point. Okay.
I wouldn't even ask the question.
Yes.
Catherine Pendley from ECAR sent a question. She says she wanted to comment that she agrees with all other commentary. However, PFC underwriting is restrictive and it could be loosened if CalCAP would pre-approve. Currently, you do not pre-approve, so underwriters have to be cautious on how we are structuring that to that type of clientele we're looking at.
Okay, we had a lengthy, I'm not sure how much of that was caught on the microphone, Ryan.
Yeah, it's kind of...
So we have a chat comment from Catherine Pendley from PACAR, and she agrees with much of the commentary so far and indicates that the underwriting criteria is fairly strict and that it would be easier if CalCAP offered a pre-qualification process. And we in fact do. Our regulations provide for a pre-qualification process, and any loan enrollment can be submitted for a pre-qual that's good for 180 days. So that is in our regulations. So so on that, for anyone who is interested in that, make sure you contact our CalCAP staff and we can walk you through that. It's basically just submitting as much of the data that you already know on our current loan enrollment form and indicating that this is a pre-qual, and we can qualify the loan as to the eligibility of the borrower and the business, subject to the certification by the lender and the borrower.
And Marco Lucioni from Opportunity Fund.
Yeah, hi. I wanted to add to what Matt said, that I think all the questions that you guys have been asking are directed to how can we expand, how can we make this more inclusive to the ones that are not being able to qualify now. And all of us as lenders are sharing with you, there are 3 levers that we can use to mitigate risk. One is down payment, another one is term, another one is rate. But none of those levers are going to expand if the ARB reserve is not increased. So if the ARB reserve altogether, for instance, was removed, the only way that we can even consider doing what we do now is raising down payments, lowering term, or raising rates in a way that those who would be eligible to do that would just be minimal. That's why we're all saying, yeah, we wouldn't be doing any lending without that. Likewise, if that reserve decreases over time, what we're going to have to do is use a combination of those three factors, the down payment, term, and rate, to be able to continue to do something. But that something is just going to shrink over time. So really, the only way that we can balance this equation is with that reserve or increased reserve. Because without it, just the lending that we're doing would not make sense.
Should we move? Any more comments? No. Let's move to the next slide. I guess this is the question that whether we are doing the adequate outreach and whether the trucking community is aware of this program, and should we increase our outreach to the community, and if we do that, do you expect that a substantial increase in the number of applicants?
I mean, we, as lenders, we do our own outreach, right? I mean, frankly, the state doesn't do a whole lot of any outreach actually about CPCFA or CalCAP. We do the one-stop events where I know staff members from CalCAP, CPCFA go. They do a great job. They answer questions. But you know, I don't see billboards up and down the valley, or notices at truck stops or places where these guys are actually at. So I would imagine that if there was an effective means of marketing to this particular subset that you guys are looking to address, then the theory would be, yeah, loans, the amount of loans we're going to issue are going to go up. But that has to be coupled from our perspective. If you guys want to start advertising to get these 75,000 vehicles off the road, we're going to need a higher reserve. So, yes, it's marketing 101, right? I don't know if ARB is willing to, or if they're going to send postcards to these 75,000 or what exactly. And Warren, if you're still there, I do have a question about that 75,000 number. Are those all in-state vehicles? Is it a mix of in-state, out-of-state? And when I say in-state, out-of-state, I mean base-plated in-state, out-of-state, including California IRP. Are those all the trucks over 14,000 pounds, or is that a particular category within that subset?
Matt, those numbers were taken from our 2016 annual report, and it's 75,000 heavies, so doesn't count the 14 to 26,000 pounds, or 1401 to 26,000 pounds. And yes, they are California plated, and California, I believe California IRP, but I can get you offline and tell you exactly what our analysis was.
Thank you, Warren, and I can pull the enforcement report. I really appreciate that clarification. I think it's important for the people on the call to hear that also, because a lot of folks aren't necessarily as close to the ARB rules as some other of us. So that's an important note. We're talking 750,000 vehicles that are only 2601 and greater. That's Class 7 and Class 8. This covers down to 14,000 pounds. And we have different deadlines, right, for different weight classifications. So the 75,000 number is probably more like 90,000. I would venture a guess. I mean, I don't want to speculate too much, but the need is probably even greater than what we've so far discussed on this call. So, who are you really wanting to reach out to? Are you just looking at non-compliant fleets, or are you guys trying to reach everybody and anybody who qualify for the program? I get that's a question for ARB again.
So we're going to start letting everyone know. The enforcement pilot project is going to start on the pre-96s, and the 75,000, we're not exactly sure. We're doing more data analysis, but it could be that they have a filter and we just don't know, because that information is not in DMV and they're not required to report into truckers. So we think it's about 75,000. We're just not sure. But we do want to send people who need to do something in 2020 to 2023 actually to more of our incentive programs, so they can get ahead of it and use the trust loan program for those who have a compliance deadline coming up and don't qualify for incentives.
But again, I mean, if we're talking about fleets who are currently in compliance, 2023. Or starting in 2020, depending on if you retrofitted and what date you retrofitted. For the most part, though, anyone who retrofitted before 2014 is going to be good until 2023, as long as they reported to you. So I can tell you, these fleets are not going to want to get too far ahead of that date. They made an investment at this point in time. They saw okay, I got this truck until 2023. They are going to go in that truck outside of a major catastrophic failure, which would probably end their business anyways, they're not going to try to jump the gun on that. And additionally, the majority of incentive funds out there are for alternative fuel. VIP exists for 10 or fewer, which is a great nexus with this program. We leverage it heavily through our dealership and our dealership partners. But the rest of the incentives are for natural gas or zero emission or near zero. This subset of the industry is not interested in alternative fuel. I can tell you that much. So when we talk about the port subset, perhaps they might be interested because they don't really know what the ports are doing, and I don't really think the ports have a firm grip on what they legally can do. So there's a lot of outliers. If VIP is encouraged and continues to get allocations from Carl Moyer, and districts who don't necessarily run VIP programs should invigorate them more, then we're going to see that, where it'll be really the lenders and the dealers who are doing the majority of the outreach to get people into this equipment. So, you know, targeting everybody is good, but you know, when we start off on the call with kind of here's the enforcement strike force, and then hey, then you guys ask us, would you guys lend to these people, and what do we need to do? It's, you know, again, they're two different bags. So if you guys are reaching out to everybody, that's great, but I would encourage your incentive funding colleagues at ARB to continue with diesel to diesel replacement for the near future.
Okay, thank you.
Thank you.
Everyone.
Any more comments? No. Next, move to the next slide. This is the fun question about the business model. Is that the question is that whether the current business model of the owner-operator is sustainable in the long run. This is based on the availability of the old equipment, old and cheap equipment. Now, is there any other, you know, of any other business model that could be replaced the current model, like cooperative, partnership, or something?
Wow, I can't resist. So, you know, the state of California has been trying to eliminate the owner-operator model for years. Primarily, that's been driven by labor. So you go and talk to an independent owner-operator who's a successful entrepreneurial individual. He's doing well, he loves his job, he's in compliance, he's not worried about it. It's not so much that the owner-operator model itself is unsustainable. What's unsustainable is the rate structure that the entire trucking industry is subject to, because people just want their things cheaper, faster, and now. It's an import-driven economy, especially in Southern California, where 40% of all the goods that come into the country come through LA Long Beach, and half of those goods stay down here. We're not a manufacturing state. There isn't a lot of opportunity necessarily for large fleets to come in, buy a bunch of equipment, and then start having employee drivers. Workman's comp, everything else related to having an employee, not to mention the efficiency side, is unattractive to say the least. So what you get is large companies like CRST, for instance, that come into California and gobble up other fleets, and now you just have massive Fortune 500 publicly traded companies operating where formerly mom and pop shops or even owner-operators used to dominate the market. So, I mean, I don't know whether or not it's ARB's job to determine what if the owner-operator model is sustainable. I'm kind of surprised by that question a little bit. And, you know, what other business models are a good fit for this industry? I mean, I'm wondering what you guys are trying to accomplish with these questions.
Matt, we're just trying to understand the industry, and we're not proposing any policy or anything like that. We're just trying to get a better understanding.
You should go talk to the industry then, because we're the finance industry. So if you want that type of information, you need to go to the American Trucking Association, the California Trucking Association, OIDA, the Owner-Operator Independent Driver Association, the Harbor Trucking Association, the West States Alliance Trucking Association. There's all sorts of associations out there that would be able to give you solid insight into how the trucking industry functions. It's not appropriate to ask lenders to chime in on whether or not the current business model of the industry is sustainable. I mean, no offense, guys. I understand what you're trying to do here. I don't want, to sound like, I'm completely poo-pooing on all of this. It's difficult for us as lenders. If you want to ask us about our clientele, we can tell you. And we have told you that literally, if you want us to continue to loan to some of these more challenged credits, we're going to need a higher reserve.
I guess the reason for this question was that if there are a lot of a small weak hand in the industry, is there a way they can join hand and become stronger, like 2 or 3 of them jointly operate a newer truck, larger truck, rather than just 2 old trucks, something like that. It was not meant to be.
Well, I mean, it's...
We are looking for is there opportunity for them to do that, moving in that direction?
Well, yeah, I mean, right now, I'll tell you what, there's a $48,000, sorry, I'm just money driven today, I apologize. There's a 48,000, driver shortage of 48,000 drivers every year in this country. When you're talking about over-the-road type trucking, you can make a significant amount of money, and you will have the opportunities with those larger carriers like CRST, or Snyder, or England, to lease a truck back from them. And if that's the type of business you want to be in, then those jobs are wide open and available. Besides that, what all of our carriers tell us, whether it's through our dealership side, whether it's through the financing side, whether it's through all my association side, is they can't find enough drivers. There's not enough drivers right now. There's a massive driver shortage, and we're looking at the electronic logging device mandate, which is kicking in at the end of this year, which for anyone who hauls any type of interstate commerce, you can be based in California and hauling a container from the port. If you're going over 100 miles away from where you started, with some other considerations, and we don't want to get into the hours of service laws right now, but you're going to, basically they're estimating another capacity crunch for drivers. So the opportunity is out there for someone who has a skill set as a heavy duty truck operator to go and find equipment, or to go and find a job and to have a company supply you with the equipment. The thing is that these guys like the independence of their job. They like making their own schedules, and they can function on purchasing a used truck because so far, evidently, they've been able to go under the radar. So it's not that the industry is broken in that regard, or there is an opportunity for them to be successful in co-ops or partnerships with other carriers. We also have to remember that the trucking industry is governed by the antitrust law. I forget which act it was right now, but so you can't collude and get together and talk about what you're going to charge on rates if you're 2 independent owner operators. It's a violation of antitrust. So these are these larger issues where it's not as cut and dry, and hey, what other opportunities are out there for these guys? There's a lot, and really for them, if they can't afford it, they're just going to go into a different industry.
Yeah, this is Russ. Let me add my 2 cents about the notion of several truckers getting together in one truck. That scares us. We try to estimate the annual mileage and the depreciation that a truck will have, and it's certainly advantageous to whoever's the registered owner with the loan to have multiple drivers bringing in revenue and still stay within California, because certainly there's a lot of night driving advantage given the congestion on the highways. But that multiple truck model works right until that truck, when it breaks down, it breaks down much earlier in the loan cycle, and the depreciation of our collateral is much greater than we anticipated. So we look out for that and try to avoid it.
Any more comments? Thank you. The next slide is about the financial hardship. Warren addressed that.
Thanks, Reza. As I spoke about earlier, we're doing the pilot project where we're going to try to reach out to about 1,500 fleets and bring them into compliance and learn from it. So as we expand towards the other 75,000 vehicles or 20 to 25,000 fleets, we have better knowledge. Part of the idea of a process that's streamlined would be for somebody, well, as we've discussed for the last hour and 5 minutes, these 75,000 folks are largely the ones that haven't done anything and probably won't do anything. But if there is a subset of those folks who actually do want to come into compliance and have a financial hardship and are unlendable, what is it that me or my team can look at to assist me in that determination that might make it more efficient or easier to understand their economic situation?
Hey guys, it's Matt. I mean, the last time we did this financial hardship exemption, you have to understand, for us as lenders, it's hard for us to get excited about that, because then we have a bunch of people banging down our doors just looking for decline letters. And it costs us money internally to go through the motions to issue a decline letter, which we typically don't do necessarily, unless you go all the way through the motions, and usually it becomes a credit decision to say, sorry, you're not going to qualify. Commercial lending is different than consumer lending, so we're not disclosing their credit reports to them or anything like that, but we're going to have to take time for ourselves to issue these decline letters. And I thought that I had heard through the trucking CB grapevine that there was somebody out there who took one of those financial hardship letters and just made a bunch of photocopies of it and was handing it out to people at truck stops. So we would like to avoid that as well. I get it. People are struggling. It's we want to support people. I know that the ARB isn't looking to put a bunch of folks out of business. Nobody wants that. And you guys have a big task ahead of you. I don't envy you, and it's important that you have industry partners such as ourselves on the line to help you guys through the motions. But if they're going to have to be coming to lenders to get the decline letter again, that's a tough pill for us to swallow. Whether or not it's operating efficiency, it'll be interesting to see what you guys have in ways of how this pilot project is going to be structured. But if all of a sudden we just got a bunch of people coming to us for decline letters, we're on the dealership side, it's a waste of time, because you need to get equipment to then run against their credit, and we just don't issue people decline letters just because they ask for one.
I understand, Matt, and I hear you. And what I don't believe, I was trying not to phrase it to have the industry provide letters for folks to come back to us with a decline. What I was envisioning is maybe what is it that ARB can look at quickly that trucking company ABC says, I just don't have the wherewithal and I need a little extra time. What can I ask them for? Any thoughts, any ideas on what I can ask them for? Is it a past bankruptcy, or is it I don't know. Some of the criteria you folks look at, what is it that I can assess easily to make that determination on my own quickly without a lot of resources? And maybe a pie-in-the-sky question, but...
Well, no, I mean, we can all give you kind of automatic declines that if somebody has, in California, if they have back child support, they're not going to qualify. If they have an open bankruptcy, they're not going to qualify. If they have tax liens, they're going to need to show that they're in some type of repayment structure. So those are three kind of major ones. Each lender probably has their own auto decline. There's a certain credit score level that lenders will use. With the onset of Credit Karma and whatnot, it's relatively easy for people to get their credit scores these days. But yeah, Warren, bankruptcies, especially their balance sheets or their tax returns are going to show how much money they're putting in and bringing home. So those are good ways. Each fleet is unique, each vocation is unique, but those general factors are going to be auto declines for us of those three, amongst other things. But some of the other lenders probably definitely have some things they might be able to share with you as well.
Thank you, man. Any further comment?
Yes, Russ, one final comment about loan decisions. If I have enough reserves, I can get around most issues looking to the reserve to support loss, as long as I can put all the information, synthesize all the information in the application and think that it's a good guy who's doing his best and will conscientiously work and try to repay the loan.
Okay, we don't seem to have any other questions on the line or in the chat box. I want to thank you. I think we all here thank all of you for your robust participation. It is multi-layered and thorny, and your perspective as lenders to these critical constituents is really valuable to figuring out how not only how the CalCAP program can serve those borrowers that you are willing to lend to, but from ARB's perspective, on a broader perspective, to figure out what's the right package of policies and incentives to bring truckers into compliance for those who want to, even if they're credit challenged. So I thank you all for your participation. If any of you have any further thoughts, input that you'd prefer to provide in writing or one-on-one, we've listed the contact information on this slide here, and feel free to reach out to anyone on the slide, and we invite that, in fact. So again, I want to thank you all. It's a little bit past time, but I think it's been very valuable to all of us, and we hope that it has been for you as well. So thank you all, and until the next webinar.
Thanks, you guys.